Hello, it's ChewDog Charts, and today we're going to talk about investors are running out of cash, and that's not good news for the stock market. Let's take a look. Well, the stock market might have a cash problem. Investors are essentially running out of it. After about 8 to 9 years of a bull market, the market is low on cash. Apparently, the money market assets make up a record low of 17% of long-term funds. The cash balance of equity mutual funds also sits at an all-time low of 3.3%. Over the past decade, low interest rates has helped push cash into investments such as stocks, bonds, and real estate. And there's not much cash on the sidelines. According to an earnings call with Morgan Stanley on October 17th, the chief financial officer indicated that we've seen cash in our clients' accounts at its lowest level. According to Merrill Lynch, they've highlighted a similar development. Cash for the group at Merrill Lynch has dropped also to a record low as a percentage of total assets. As we can see of the chart shown, we're currently at record lows, even lower than the 2008-2009 financial crisis and even lower than the 2000 tech bubble. Back in July, Citigroup said that institutional investors they surveyed were holding roughly 2.25% of assets under management in cash. That's the lowest since at least the start of the recent bull market. Now, throughout the past couple of years, stock bulls have used the argument that the excess capital on the sidelines is waiting to flood back into stocks and will push the market higher. However, that argument isn't as valid today. After all, in the year 2000 and 2007, prior to each of those downturns, investors were confidently holding similar low levels of cash. Goldman Sachs is bucking the trend, indicating that their data finds that investors are holding about 3.3% of mutual fund assets, which is in line with recent history. However, as you can take a look at the chart here, as of June 2007, the level of cash currently is well below any other time period going back to December 2008. As we can see in this chart, which is the New York Stock Exchange margin debt compared to the S&P 500, the peak in the margin debt appears to precede the peak in the S&P 500 by at least a few months. So the cash levels that we're currently seeing at record lows compared with the record highs of the margin debt is important to keep in mind when we're taking a look at the stock market and considering future investments. So keep it in mind. For now, that's ChewDog Charts. Thank you.